But then what I felt like I was seeing for about a week is a big discussion about the bank as being troubled or close to failure. Like
Right.
on Friday, and I don't know if you saw this, there was like failure watch for New York Community Bank. And I thought that that was so insanely misplaced and such a misunderstanding of what was happening, and really obscures like what's actually going on and what's going to happen next. And I think, I think a lot of people, kind of don't remember that the SVB failure was anomalous.
Yeah.
Very specific. And they also kind of don't understand the full mechanics of a bank failure, but they've just seen a couple and they're like, well, this is how it always happens. And I'm here to correct the record. This is not how I always happens. So it just went from being like really interesting to being really stupid really fast.
Yeah.
Now, to their credit, New York Community does a couple of things. They elevate the former CEO of Flagstar, which Flagstar, before it was acquired, had a number of regulatory issues.
I remember.
Yeah. And so they brought him on, they keep him on the board, and then they elevate him to executive chairman. They also disclose their deposit stability, because this is actually why people are being stupid.
Yeah.
They actually, I think they assume that these results, that depositors care about how much money the bank made. And if the bank reports that 2 loans took a charge and the dividend is cut, they're going to pull their deposits. Like that's literally like what it seems like is A then B.
Yeah.
And so the bank says that deposits are actually up from year end. So, through February, total insured and collateralized deposits are 72% of total deposits. The bank has more than $10 billion of reciprocal deposit capacity.
Yep.
It only has $22.9 billion of uninsured deposits. 90% of the top 20 deposit relationships are fully insured or collateralized. The bank also has $37.3 billion of liquidity, which is a coverage ratio of 163% of uninsured deposits. So if all the deposits left, they were at 163% of uninsured deposits. They also have $17 billion of cash on their balance sheet and $6.1 billion in unencumbered or unpledged securities. Also, we've talked about this before, but they have a fully collateralized credit facility at the New York Federal Reserve Bank, which is their discount window connection.
Hey.
And they have excess lendable collateral at the FHLB of New York, totaling $14.2 billion. So I would say this bank is extremely liquid.
Yeah.
And probably, I'm not saying they can't have a deposit run, because insured deposits can run. That's, people can worry about their money.
Yeah.
But this seems like a bank that could probably have all of their uninsured deposits leave tomorrow and stay alive, stay solvent.
Yeah.
So, I think that, the bank did some things right and some things wrong. And, but I think I always prefer to see action versus inaction. I think, in 2023, we saw a lot of banks that were wait and see, and then they acted too late. And I'd rather, if your bank has to take a negative action, take it sooner than later. Your first loss is always your best loss. So the transition of a CRO and CAO without finding someone with that big bank experience, I think is really important. But I think, people were really concerned that the bank just doesn't have one right now. And they'll remember that at SVB, they also didn't have a chief risk officer for an extended period of time. The liquidity looks good. I think that was really important. I don't think the bank received equal credit to the sell-off that they had received for bringing in all that liquidity. I also think it's really reasonable that a bank with a large rent control portfolio will need to build its allowance period. I think that what was confusing is why has it been taking so long to build the allowances?
Yeah.
To see the charge-offs. We have been waiting for credit to crack for a year, at least I have.
Yeah.
I think you want to see a gradual build of the ACL, but genuinely CECL, the rules of CECL are that if the lifetime loss of a loan is increasing, you have to increase your reserve, and you want to be increasing the ACL before you take the charge-off. So it's really good that its ACL is $1 billion, but their charge-offs are 1.8 or 185 million, right? That's
they're
that's
way
what
ahead
you
of that.
need, right?
Yeah.
You don't want to see ACL you don't want to see the same amount of ACL building or the provisioning and the same amount of charge-offs in the same quarter, right? Because
Right.
that means they're not CECLing correctly.
Yeah, they're behind the curve a bit. Yeah, no, it is really interesting, right? I mean, I kind of to your larger point, the thing that I struggle with this is we want banks to do exactly what these guys are doing, right? Like, okay, you had a bad quarter, right? Like some loans. I mean, it sounds like the loans even weren't like that badly performing, but like you had to do some accounting stuff to adjust some loans that aren't performing quite the way that you would want. All right, so that's going to impact earnings. Fine. But like, to your point, all of the things that they're doing are proactively making sure that they're in a highly liquid position to absorb any stress to the bank, right? Like they're doing exactly the things. They're tapping the discount window. They're making sure they have unpledged collateral with. Yeah. They're able to. They've lined that up. But I mean, like, but that's a good point.
But like that's why Signature failed, right? Like that's
right.
why
They weren't prepared.
They weren't prepared, right?
Right.
And